Well, who better to talk about this today than our best-in-class guest? We have Morningstar's International Stock Fund Manager of the Decade. David Herro is the portfolio manager of the Oakmark International Fund. It was up more than 56% in 2009, beating 96% of its peers. And David, great to have you with us. And, you know, I know that about, 66% of your portfolio right now is allocated in Europe. So certainly you've been watching the situation. I also know that you're a bottoms-up kind of guy. So you're not really going to be paying attention to too much of the macro news and how it affects your strategy. But I still have to find out from you, what do you think about what's happened over the course of the last 7 days in Europe?
Yeah, well, I mean, it's not completely unexpected, because when the European monetary system was constructed and you had European Monetary Union, you put together things that did not belong together. You had so many economies that were dissimilar, both from a macro and microeconomic perspective, and then you label them all with one monetary system and one monetary policy. When those individual economies start to diverge, you're going to run into trouble. I'm actually kind of surprised that it took this long to happen. But as I think Milton Friedman said quite some time ago, it's inevitable. And I think the real question is the philosophical soundness of the whole European Monetary Union and putting together things that don't belong together.
Well, then, are you saying, David, that you would welcome if some of the countries in the euro actually left?
I think from an economic efficiency perspective, some countries in the euro should leave. They don't belong there. Spain and, not Spain, but let's take Greece. Greece and Germany have almost nothing in similar. They have different micro policies, they have different macro policies, they have different abilities to withstand economic pain and adjustment. They just don't belong together. So why are they together? They shouldn't be there.
Okay, but barring that from happening, though, David, because it looks like the EU leaders are committed, at least for now, to bailing out Greece. What if Greece started bailing out their private sectors, or what if Europe started bailing out their own private sectors to stem this sovereign crisis? How would that affect you?
Well, what we do is we look at how any of these policy actions or how any of these macroeconomic wins impact the companies in which we invest in, how they impact their ability to earn money and generate cash for their shareholders. So sometimes this is actually a very good environment for us to invest, because often you just have blanketed fright that as people move away from a region or a sector, all because of a little turbulence, even though in the medium and long term it may have little, if any, impact on an individual's company ability to generate profits. So this is what we see often as a good opportunity. And it's not that we don't ignore macroeconomic policy per se, but what we try to do is connect it with the companies in which we're invested in ability to make money for their owners.